for being here at this hour. 8 o'clock on a Wednesday evening is not a small ask. And the fact that so many of you chose to spend it with us tonight says something about, I think, how important these conversations have become. So let me introduce myself. My name is Sofía Tafur. I am a member of the Semillero de Derecho Societario y Operaciones Societarias at the Pontificia Universidad Javeriana, and I will be moderating tonight's conversation. Before we get into it, I want to take a moment to acknowledge the people who made this evening possible. First, Sofía Lizarralde from our compliance research group, and Pablo Rocha, whose support gave this project the foundation it needed to move forward. Also, Santiago Ramelli, who handled all the logistics and made sure everything worked tonight. Thank you to all three of you. And of course, to our two guests, who despite genuinely demanding schedules, agreed to have this conversation in public at this hour with an audience that I hope will hold them to what they say. So that is not nothing, and we are very grateful for it. So everyone, we are not here for a lecture. We're not here for a rehearsed set of talking points. We are here for the general overview that you can definitely not find in a compliance handbook. We have 60 minutes with two people who have sat on the opposite sides of the regulatory table, who have built governance structure, enforced them, watched them hold, and watched them break. The conversation we're about to have is one that most audiences in Colombia do not get access to, and we are very fortunate to have it. Our working premise is simple. In fintech, crypto, and digital assets, governance and compliance are no longer just legal obligations. They have become commercial variables. The difference between closing a funding round and losing it, between keeping your banking relationships and losing them overnight, between maybe surviving regulatory scrutiny or not surviving it at all. The rules of the game are changing, and the people in this room are the ones who need to understand the new rules before everyone else does. I think we have the privilege to be joined by many students. And as I was telling Gregory when he first joined, I think tonight Maria Claudia and Gregory will have the opportunity to start shaping the future professionals of compliance in fintech and crypto. So we will have 5 questions to guide the conversation with about 5 minutes per response for each speaker. If an interesting thread emerges, we'll stay and maybe move on from anything that feels more repetitive. And as I was saying before everybody else joined, we'll save the last 10 to 15 minutes for audience questions. So please, guys, feel free to share them in the chat throughout the session. And our team and Sophie will choose a few to close, along with a practical takeaway from each speaker. Now, please allow me, guys, to introduce our guests. We have Maria Claudia Martínez, our first guest. She's a partner at Martínez, Quintero, Mendoza, González, Laguado, and de la Rosa, one of the most respected commercial law firms in Colombia. Maria Claudia has spent her career advising companies on precisely the kind of regulatory and commercial complexity that defines this sector. The friction between ambitious business models and the very real constraints of operating within a legal framework that was not necessarily designed with those models in mind. So she brings to tonight's conversation the Colombian implementation angle, what it actually looks like to build governance and compliance programs that work in this market for these regulators under these conditions. Maria Claudia, it is truly a privilege to have you here. Thank you.
Thank you. The privilege is mine.
Our second guest is Gregory Lisa. He comes from the US, as his Captain American shield in the background can attest. Gregory Lisa is a senior counsel at Hogan Lovells. Gregory's biography is definitely one of the more unusual ones I have come across. And I say that as the biggest compliment ever, Gregory. Gregory spent nearly a decade as a prosecutor at the US Department of Justice. He was among the first enforcement attorneys at the Consumer Financial Protection Bureau. He later led enforcement at FinCEN, which is the US Treasury's primary anti-money laundering regulator, which means he spent years deciding which cases to bring, which companies to investigate, and what standards of governance and compliance actually hold up under scrutiny. He then became the first chief legal officer of a DeFi company, so a decentralized finance company, crossing entirely to the other side of the table before returning to private practice at Hogan Lovells. Gregory does not just understand how regulators think, he was one of them, and for a long time. So Gregory, thank you for being here this evening.
Thank you so much. I really appreciate the invitation. I apologize for one thing, which is that I never learned Spanish well enough to be able to present it. So my apologies for that. And thanks again for the invitation to be here. I really do appreciate that.
Thank you, Gregory. So with that and our great biographies, let us begin. The first question is, I want to start with what I believe is the most foundational question of the evening, the one that sets the stage for everything that we will hopefully discuss. So, Maria Claudia and Gregory, in today's market, what governance and compliance weaknesses most quickly undermine confidence? It can be either from regulators, investors, banking partners, or counterparties in the fintech and digital asset businesses. So, Maria Claudia, ladies first.
Thank you, Sophia. Well, first of all, I want to thank really the Semillero for this invitation and the University Javeriana for this invitation, Sofia, both Sofias, Paulo, Santiago. It's really a pleasure to be here. I hope you have me once again. I hope to do well enough so I could be here once again. And Gregory, it's great to share with you this panel. To answer your question, Sophie, I would say first, what do you understand for confidence? Because for me, confidence is actually to message all stakeholders that you're really controlling the company you're running. Right? Are you controlling it, or are you just like making it grow without any structure, without any governance, without any risk assessment to be sure that the company is actually going to be to exist in time, right? It's not going to be just like, because I see here a lot of people, right? A lot of students and in general, a lot of people in this panel. And it's because actually today it's sexy. It's sexy to be in the technology market. It's sexy to be related to a crypto company, to a fintech company. You know, it's the future. That's what they say. So, and you see a lot of fintechs, a lot of startups in general related to technology that actually start growing, but they don't really have the governance structure to really exist in time. And you just see that after a few years, maybe not a few years, just a year, they're already gone, right? So for me, confidence is actually that you message all stakeholders that you actually are controlling and ruling the company as it should be done. So I would say that there are the message that you actually give the market are important. And there are certain messages that actually undermine that confidence from different stakeholders. I would name Four. The first one would be to have a superficial or ineffective board. Yes. So when this company is starting to grow, you actually have a board. Yes. But it's important for that board to actually understand from one side technology and from the other side the financial business around the company, the technology, and what they're trying to give, like the service they're trying to render to the market. When there are superficial boards that actually just do what the founder of the company tells them to do, that messages the market that it's not really a company, that it's considering all its governance seriously, right? So one is that a superficial or ineffective board oversight, I would say. So they're looking actually for companies that are not passive. They're really structured governance board. Second one, I would say, and it's really important, and I'm sure Gregory agrees with me, I hope so, is to have underpowered compliance functions, right? When you have compliance functions that are really, you just have a compliance officer or a compliance team just to say that you have a compliance team, but they don't really have direct communication with the board. They don't really talk directly to the CEO of the company to make them aware of the risks there are because of the business. Well, you're actually showing the market that your company might be exposed to, for example, AML risks or money laundering risk or corruption risk, because we all know that a lot of these companies have been used to actually commit money laundering. So if you have compliance teams that are really not robust enough and are not empowered enough, that's actually a message that you're sending to stakeholders that are undermining confidence. Also, it's important to, like, from a compliance perspective also, and like a governance too, to identify risk appropriately. It's important for the company to understand the market they're actually functioning in, which are the risks they're exposed to, how to mitigate them. Because what undermines confidence is that actually these risks are not identified internally, but externally. If, for example, a regulator identifies a risk the company is exposed to and asks the company how they're mitigating the risk or how they're applying controls or implementing controls to mitigate these risks, well, and when they get the request for information or the request from the regulator, and you haven't really identified that internally, you're sending a message that they shouldn't be confident on your company, that it's growing without control, right? And finally, it's lack of transparency. When stakeholders, regulators, counterparties, banking partners, etc., actually see that there's lack of transparency from the company, well, that actually undermine confidence. When there's no there's actually inconsistent communication between, for example, someone in the company, the CEO, but the CFO says another different statement that actually sends a message that the company is not being controlled, but actually is under no control. So that undermines confidence. That would be my 4 messages that quickly undermine confidence.
Thank you so much, Maria Claudia. It was definitely enlightening. I resonate a lot with the last point, that actually transparency and recognizing one's own faults can lead to more confidence on the other side of the table. Please, Gregory, we would love to know your answer to this question.
It's so funny that Maria Claudia said, like, if Gregory disagrees. First off, I fully agree. But second, even if I didn't, Maria Claudia is really smart, so I'm not going to disagree with her on anything in this presentation. So just so everyone's aware of that. No, first off, let me echo something that she said in the very beginning. I did want to extend my thanks to Semillero and to both Sofias and especially to my colleague here, Maria Claudia. I really just appreciate the invitation to be here and to speak with everyone tonight. It's just a great opportunity, and I love just interfacing in these discussions much more than lectures or other kind of formal presentations. These discussions, I think, are wonderful. To answer the question, and I think I love the way the question is framed too, because the confidence or the expectations not only come from regulators and law enforcement, but also from counterparties like investors and banking partners. You ask many tech companies, you ask many financial services companies, who is their toughest regulator? Is it the provincial, or is it the state or federal, or is it criminal or versus civil? And they'll often say, no, it's my bank. My bank is my toughest regulator. They're looking, they want to be sure, in part because they don't want to be part of an operation that doesn't take compliance seriously. They don't want to also be part of an operation that is then connected to a drug cartel or a North Korean money laundering regime or a weapons proliferator somewhere. And I think many of those investors and banking partners and counterparties don't want to be in partnership and having financial transactions often, whether investment or just banking relationships with companies, especially new startups that don't take their legal obligations seriously. I think the other piece of it, and something that Maria Claudia was echoing on, is that the failure often comes from the top. As an expression, the fish always rots from the head, right? That the tone at the top will matter. And if the leadership, I think one of the most important compliance weaknesses or red flag for weakness can be when the tone at the top does not sufficiently support the governance and compliance function to essentially say, yes, we have to do this. We'll put this over in this department. But essentially, unless that leadership, whether that's at the board level or at the senior management level, unless they actually take that seriously, it doesn't matter about anything else, because everyone is going to follow what the leadership values or doesn't value. And that's not just in terms of things like promotion and compensation. That goes all the way through the organization, the tone at the top. Second is, and I think it's also something that is consistent with what Maria Claudia was alluding to, is the overemphasis of profits above all else. Now, look, these are all companies. They're not nonprofits. They're not charities. They're there to run a business. But sometimes if those interests, whether business or marketing or whatever, eclipse everything else to the point that the best way to make a profit is to break the law or to cut a corner. Compliance is costly, and sometimes they're looked at as drains on businesses instead of a productive component of a business. And sometimes the messaging and the actual compliance processes or how it's taken within the business does play a role in how regulators or investors or banking partners or others will view that company. It's obviously overlap with some of our later questions, but I think that those things, like the tone at the top and having the appropriate role of compliance, even in a profit-making organization, I think is going to be thematic through all of our questions and discussions today. So let me just leave it at that.
Thank you so much, Gregory, and thank you so much to Maria Claudia. I think I like the expression that leadership is so much more than having the idea. It's really implementing it and guiding the team through everything. I think that also gives us a picture of what failure kind of looks like. But I want also to kind of, I guess, go more in depth to what you guys believe success looks like in practice. Because I suspect, correct me if I'm wrong, that there is a significant gap between companies that say the right things and companies that have actually built them into what they operate. So as Maria Claudia was saying at first, that compliance is not just for show, that it actually works internally. So I want you guys, if you could perhaps go a bit more in depth into that. So the next question would be, when a company says it takes governance and compliance seriously, what are the concrete features you would expect to see in practice, as opposed to formal policies that exist only on paper? So we have a compliance officer and that's it, but what are the features that actually show that a company is really means business when they talk about governance and compliance?
Go ahead, Gregory. Let's start the other way.
I know. I thought we were going to start strong with you. Okay. No, I love this question, and I love that Sophia had put it together. So there's a management expert who came up with this phrase. So it's definitely not mine. His name is Peter Drucker, and he said that culture eats strategy for breakfast. That's what his line is. Culture eats strategy for breakfast, and basically the meaning of that is that you can have the best policy in the world. You can have the best document, the best set. You can have, the best set of compliance policies in place. But a bad corporate culture, it then makes that a recipe for failure. The only thing you'd have then is a document. It's like having a dictatorial country, that has a beautiful constitution with all rights spelled out, all of which are ignored. So every single company, or every company that has any sort of sense about it, is going to have a policy that says that they take its governance and compliance policy seriously. Everyone has that. Like their lawyers from day one, if nothing else, they have a macro that says that, and they put that in their, employee manual or compliance manual. No company is going to say, yeah, we don't really care about the law. We're all about kind of breaking the law, and we're fine with it, right? So everyone will have a policy like that. The big question is, are you going to walk the walk? And so many regulators and law enforcement, and we did this when I was within the Treasury Department, we would look at the gap between policy and practice, between what the company says it does and what the company actually does. And that, I think, is very key to this kind of culture of compliance issues. Does the company in fact take seriously the obligation? And so what can help prove that? Well, if they independently test, if they do an audit of their compliance program, not to make sure that the words on the page are right, they're fine. The words on the page are fine. But in fact, are those things being taken out in practice? So they can do things like transaction tests. They can do things like do employee quizzes. They can actually take attendance at training sessions, or ensure that the employees actually know what has to be done. You can look at proactive reporting and engagement with regulators. When a company makes a mistake, are they forthright about it? Do they come forward to their regulators, or do they take affirmative steps to fix the problem before they become disasters? And something else that in the last question Maria Claudia had alluded to, resource allocation. Having a compliance department in place is one thing. Having it actually supplied with the requisite amount of personnel, with office space, with independence, with technology, that actually makes a difference, and that's a real tell. So we had a case back when I was at Treasury, and they had a program that was, it said for suspicious transactions, suspicious activity reports, that would be sent to a suspicious activity committee. So we were prosecuting a casino in this case. We did a number of cases on casinos. And so for suspicious transactions, those would get sent over to the suspicious activity committee, the review committee. And it was all well spelled out on paper. The only problem is When we did the investigation, we said, so how do you guys assess these suspicious activity reports? And they said, we send them to the committee. And so we went and we said, okay, who is on the committee? Well, Alice and Bob and Charlie are on the committee. So what do? We went to Alice and Bob and Charlie. I said, we don't know anything about this committee. We've never met. I didn't know I was on the committee. So it was very clear the distinction between what was said in word and what happened in practice. And that was a big red flag for the compliance program. So let me just stop it there because I think Maria Claudia probably has some better examples.
I love everything you say, Gregory. But maybe going back to the answer to your first question, I would say that I love when you said the banks are the most tough, let's say, regulators over companies. And it's actually how a lot of clients end up being advised by me, because they say, okay, I have this great, in this case, fintech, this great fintech. I know that I have to have some compliance programs because the regulation in Colombia makes me have some compliance programs. I actually do report all the information to the superintendents, all the information I have to report. I'm really compliant with that. But my bank just told me that they're going to close my operations because they think that my compliance program is not robust enough. Then I start asking, okay, what do you have in place? I have this policy. That's great. It's really easy nowadays to have a policy and to show a policy. But what do you really do in practice? Okay, no, I don't have a compliance team. I don't have a compliance officer. I'm actually coming because I need you to prepare and do everything for me to have a compliance robust team, or else my operations are going to be shut down. And that's actually something that has to do with the question you just answered, or what you just mentioned, and is that sometimes policies are there, they're existent. I agree that most of the companies say that they they want to be compliant with all the regulation, that they are actually that they have really robust policies in place, but the truth is that they don't implement them. The truth is that the committees that are mentioned in the policies don't exist. The truth is that when they get, for example, a report, because they actually have our ethics line, they receive the report and they don't know what to do with it. What are the steps? They don't know their policies, and they don't actually make their employees or the people that actually are related to the company understand their policies and how they function. And that is actually have to do with what board and senior management level are accountable for. If you really have not just the policies, but you actually implement committees that take place, right? Because in Colombia, we see a lot of companies that actually have committees, but they don't really take place. Maybe they have minutes, but these minutes are existent just because they need it for the regulator, but they actually don't have the meeting. Yes. So it's really important to implement what they say they have in their policy, and have, as I mentioned, accountability from the senior management or the board is really important. Also, the audits that Gregory mentioned, it's important to have internal and external audits, but not just external audit from a friend that it's actually auditing me and to show that I have external audit. No, it's auditors that actually do their work as they have to do it, and the company actually receives the reports from the audit as a way to make things better, to learn from what is where there is a gap, to close the gaps that are identified. And if internally they have auditors also, actually for the internal auditors to be really strict on what they're asking for, and to have steps after the reports or the gaps are identified, to have steps to close those gaps, but that the company actually takes this seriously, not just to show, but actually implements this. And also it's important to for companies, I always talk about risk and risk identification, and we know that markets are all the time, they're moving, right? Their regulation is different today that is it's going to be tomorrow, or it was yesterday. And because of that, it's important to have a risk identification or procedures or controls that actually can be updated, let's say, or can be modified, or can be dynamic, so they can actually identify where the company is standing each day, and that they're not just, I have the same policy or the same risk assessment I did 10 years ago or 5 years ago, which was a completely different context where a company could be today, because, as I mentioned, context are different every year. And in these companies where a lot of regulation is being expedida. Well, yeah, a lot of regulation is being done by the regulator. So yes, it's really, really important to have dynamic procedures and policies.
Thank you so much, Maria Claudia. That actually fits perfectly into the next question. You guys were talking about how having a compliance team is costly, not only in terms of money and having a compliance system with the features that walk the walk and not only talk the talk. It's also time consuming. It's very costly in terms of time. So when you have that tension between speed and control, I think it's a common stress point for companies. As fintech and digital asset businesses scale, where do you most often see a mismatch between the commercial ambition on one side and when we talk about those systems that are robust, we may talk about compliance maturity. So when do we see that mismatch, that maybe dissonance between the two?
So I would say when there's an accelerated growth that you actually can perceive either internally or externally, that the growth outpaces the governance of the company, and that the committees or the different corporate bodies cannot have the time to discuss and to identify risk or structures or new business lines that want to be implemented but are just being implemented, and because they want to grow, and well, this growth actually outpaces the governance structures. I would say that this happens mostly, from my experience, when there's geographic expansion, because normally companies that start in one jurisdiction, when they start as startups, maybe no, but when they grow a little bit more, they understand what the local regulation wants them to comply with, what they have, the authorizations they need to perform the activity they want to perform. And when they do this geographic expansion and they just start operating outside, they sometimes, just to grow, they don't identify the rules in that jurisdiction, right? The regulation, it can be similar, but still you have to have everything in place as that jurisdiction asks for. I have a lot of clients that actually they grow, but they don't grow from Colombia, but they grow from elsewhere, and they come to Colombia and they tell me, I have the best compliance program. And I said, okay, great, that's great. Let me see it. And when we see it and we read it, of course, it's great, but it doesn't comply with local regulation. It doesn't comply with local risk because Colombia actually has, as I always say, a history as a country regarding violence, regarding corruption, regarding drug dealing that is different from a lot of countries. And because of that, the risk assessment in Colombia has to be made locally, has to be different than in other jurisdictions. So maybe that geographic expansion is one of these things that, like an example, when growth actually space governance structure. And yeah, I will stay there just to have Gregory answer.
No, I think that's an excellent answer. It's tough to do better than that. So I'll be super quick on this. I think, and I love this question as well, Sophia, because I really do think that there is, commercial ambition and compliance maturity. There's often such a tension between the two, and especially in the the digital asset space or fintech. And I think that's in large part because you look at the nature of this business or these businesses, and there's incredible technology by people who are basically aligned towards or really looking towards disrupting certain features of financial innovation or financial practices with incredible innovation. And these are often people who I loved working at my DeFi startup because I was surrounded by people who were half my age but twice as smart, which was a great place to be. I learned a lot from them. I mean, they were all brilliant coders and engineers, and they were fantastic. Really did. But combine that, the incredible tech with as well as incredible marketing and, an ungodly amount of venture capital money. And that venture capital money especially was looking not, they were looking to elevate those businesses, for some of them to go public. Not all of them would. Many of them would fail, but a couple of them could be the next Uber or the next Microsoft or the next something else. If they did, then that's a success from the view of the venture capital investor. The challenge on the compliance side is that things don't always move so fast. And again, remembering when I was back at a regulator, I would say, like, look, don't build a car that can only go, faster than 100 kilometers an hour and then complain about the speed limit. Because if you do, you're going to wind up with a problem where you may have created something and you haven't built the compliance around it. You haven't built something that makes it not just appropriate and legal, but as Maria Claudia was alluding to, legal in that particular jurisdiction. I think the only other area that I think this comes in, it's very highlighted, is for, as your question is talking about, where the company scales so quickly. And sometimes it's very easy to get caught up in customer volume or transactional volume or acquisitions without making sure or paying attention to the fact that, hey, listen, we just came up with a new product, or we just expanded into these new jurisdictions, or we're now doing 10 times the amount of transactions that we did before, without making sure that you have the right amount of people and technology and resources on your compliance side to make sure that your company is still staying on the right side of the law.
Thank you so much, guys, for your answers. I like that we have the international perspective and the growth aspect of everything, because now most fintechs are cross-border and global, and they aspire to a world domination. So sort of that perspective, do you guys think that there is such thing as international compliance regulations, and more to it, like international expectations, and what the friction is between that international expectation and local implementations? You touched on the subject, Maria Claudia, when you talked about the Colombian context, which is very peculiar to say the least. So when a business is operating across regulatory environments, can we say that there is an international expectation versus a local implementation?
Go ahead. Go.
I think she was asking you, Maria Claudia.
Oh, sure. Sorry. Yes. Okay.
I'm asking both of you.
Yeah, I think it was both, but yes, I'll answer. I think there are international standards, yes, but and they're mainly driven, from my perspective, by this idea of having like all countries like fight against terrorists, against money laundering that is related to terrorists too. It could be related to terrorists. And those are the international standards. But as I mentioned, the local standards can be really different from country to country. And actually the importance related to the local regulation, it's mainly driven by, like from my perspective, from the experience I have, from the idea, from the importance that country economy has for the company that is actually exploring different jurisdictions, right? So that being said, I would say that, for example, a company that is entering the Colombian jurisdiction, that really, from my perspective, I consider that is one of the most demanding jurisdictions that has compliance regulations that are really mandatory and that are robust and really detailed to be implemented by companies locally. If this actually has to do with the resources the local compliance team will have to implement, these compliance structures. And if for the foreign company, even though it has international standards and it complies with the local regulation for them, and it actually has procedures and committees and everything to identify risks, to actually fight, let's say, or prevent risks. The truth is that if for the foreign company, the Colombian economy is not that important, they won't give all like the resources they need for a compliance team to be robust locally. And unfortunately, from my perspective, inadequate localization of the programs are like at the end, what they show is that companies are prioritizing growth over compliance or, yes, regulatory environment, say, locally.
I agree with that. I think there are definitely some areas, especially so I spend all my time doing nothing but anti-money laundering. If anyone is looking at getting into this field, please reach out to me. I will never stop loving reading and learning and practicing AML. It really is, to me, the most interesting area of the law I've ever run into. And there are some international standards. There's something called the Financial Action Task Force, which sets international standards that all countries are supposed to subscribe to, and they try to harmonize the differences in national regimes, regulations, and on laws. But there are still differences. And much like there's still differences. I mean, look, my country, I don't agree with it, but my country still has sanctions against Cuba. And that's on a sanctions, not an AML regime, but that's something atypical. That sometimes when we get companies from foreign jurisdictions wanting to practice in the U.S., we have to remind them, and then they ask us, what are you doing about Cuba? So, I don't know, but it's the law, so just abide by. And there are some other smaller, not smaller, but other much more particular areas, such as privacy and cybersecurity, that some companies are still kind of getting, some countries are kind of building up their regimes. So this big difference between, something that would be actually allowed in one country would be prohibited in another. And there are actually some areas of the law where something actually could be required in some instance that would be prohibited in another, which leads a cross-border company to be in just having to navigate what country's laws are going to abide by, or how to navigate those particular conflicts of law situation. It's a really challenging issue, especially when we get into things like cross-border payments and cross-border companies generally.
Thank you, Gregory. I have a quick follow-up question. Did you encounter, or more specifically, how do U.S. regulators assess compliance programs that were built clearly or primarily for a different regulatory environment? How would that work?
Yeah. So, I mean, often, and U.S. law is pretty tough on this for foreign companies, in part because, in part because the United States has a very, kind of imperial view about the reach of its law, but also because they'll say, look, if you want access to our markets, if you want access to our customers, you shouldn't just ensure that your laws, that your practices comply with Belgian law. If you come here, then we need you to make sure that you're compliant with US law. And so they will assess it really through a US lens, and sometimes to the point of saying, look, you need to, they won't say you need to hire this lawyer, but they will say you need to get US counsel on board, to make sure that what you are doing here is compliant with US law. That I've seen that happen actually quite a lot when we have a very international law firm. And so we'll often have foreign companies trying to enter the US market. And this is especially true in the crypto space because we've now become much more flexible. But some of those companies from overseas are now having to, change their programs and change some of their practices to conform to the expectations if they want access to the US markets.
I want to add something there, like from my experience, and it's not even if they're actually entering the US markets. Sometimes they actually have to consider US law, even if they just like have a transaction or a bank related to the US. Well, you obviously know that, and it's sometimes difficult to explain to Colombian companies that they actually have to foresee this. And if they actually want to do business with Cuba, for example, well, yeah, of course, Colombia doesn't have sanctions against Cuba, but wait, because maybe even though you're not in the US market, you could have a relation with the US, and that means that the US can actually have an impact on your operations tomorrow, because they actually can sanction you for having a business in Cuba. So I was just at that's really that has an impact on Colombian companies. even
Yeah,
though
no,
they're
it's an excellent
present
point.
in the market, in the US market.
No, it's an excellent point.
Thank you both for these amazing answers. I think it's great that we have come to the conclusion that as a Colombian company, you have to take into consideration not only US law, but US politics in order to plan ahead compliance-wise. I think that's that's a very interesting analysis. Thank you to you both. That was exactly the kind of candid, kind of practical conversation we hoped this evening would be. And we do have some questions from the audience that were sent to Sophie internally through direct message. So please, Sophie, go ahead and shoot.
Okay, so first of all, I would like to thank you on behalf of our team for participating today. It has been a really amazing space. So thank you very much to both of you. Because of time, I chose like the two most important questions I think would bring a lot of value to the end of the conversation. So first of all, Colombia is an entrepreneurship ecosystem that continues to grow more and more. Based on your knowledge and expertise, what advice would you give to all those who want to start a fintech company?
My first advice is, like, from the beginning, identify if the Colombian regime actually accepts the service you want to provide and the financial service you want to provide with tech. Why? Because I see, or even if there's a window where you can actually provide that service, because we see a lot of startups that actually are great ideas from really, as you mentioned, entrepreneurial ship that is like existent in Colombia. And well, obviously the right now it's different than it was maybe 10 years ago, which is not a long time ago, because right now fintechs are actually accepted and there's like an ecosystem to accept fintech and give them viability. But before it wasn't like this. So they had great ideas, great financial services they wanted to provide. But they were clearly illegal from that perspective, like from the context they were creating it. So sometimes it maybe sound like a little bit not welcoming what I'm gonna say, but it's great that you have a good idea. I'm sure it's a good idea, but also question why that good idea hasn't been implemented by anyone else before. Yes, from that one thing. Another thing, really, day one, you have to understand the regulation to see if it's possible to implement that idea you have, or that fintech you have, or for the provision of financial services. And if not, from that context, see and have like an interaction with the supervisor or the regulator to see if it's possible to implement it in the future, because you can start today and maybe in the future you could implement it, and it takes time also. So that's one thing I would say. See, like from the beginning, review the viability of the fintech from a regulatory perspective, and if you actually see that it's possible to implement everything, let's say, in compliance with regulation from the beginning, because that would help you not just have an economic business that is legal, but also to have possible investors in the future actually invest in your company, because when they perform the due diligence, they actually identify that you're in compliance with their regulation, and that you have procedures and everything in place to that it's a serious company, what I was saying in the beginning, but I will leave it there.
No, that's a great answer. And it reminded, but back when I was a regulator, back when I was at Treasury, we met this team at the young, very highly intelligent, and we went through kind of their business model, and it was for remittances. And we talked through a couple of things, and I said, but you can't do that, because then you could have money running through undetected in and out of North Korea. I said, you can't do that. And he goes, no, you can. Let me show you. And he like flipped open his laptop, and he's like, no. I mean, you can't do that. I understand you can do that. Don't do that. Um, but no, I think the broader point is also this, that sometimes it helps. I agree with what Maria Claudia was saying about understanding what the rules are in advance of building the product, because you don't want to build that car that can only go more than 100 kilometers an hour, and then complain about the speed limit. It's sometimes helpful, and don't count on this, but sometimes helpful just to also, if you do realize what the legal or regulatory roadblock is, what the problem is, to look at what that regulation or law, the purposes behind it. And that doesn't mean you can meet the purposes and therefore get an excuse or get a defense. But sometimes it does help you look at ways of building your product or service in a way that meets the goals of that regulation. And then it can help you interface with the regulator. And most regulators, and I've been in this situation before with clients where we've gone to the regulator and said, like, look, we have built something, or we have plans to build something that does not meet your regulation. It does not meet the rules as we want to suggest how you can build a new regulation, or how we can get an exception to this regulation and still meet the goals, maybe even be better than the other programs that are out there that are technically compliant with your rule. And that don't count on that always happening. But I think especially in the digital asset space and fintech and crypto, that does happen. And I think it's happening more than previously.
Okay, thank you for your responses. And the second one is okay, so considering that fintechs handle massive volumes of data, what role do artificial intelligence and machine learning currently play in detecting money laundering patterns, and how do they mitigate the risk of false positives?
I'll let you answer, Gregory.
Okay, no, I'll give this a shot. So it's a really good point, and I think the goalposts and the sands are going to change on this over the next. So anything we say now, like 20 minutes from now, it's going to completely change. So don't hang too much on this, Nicola. I think that more and more regulators, including my former employer, FinCEN within Treasury, have started to. They were always reluctant to say that companies must use this, must use AI, and I think that there's a real tension there, because there's both opportunity to do things you couldn't do before, as well as heightened risk, like the risk of deep fakes or of bad guys using AI to circumvent compliance processes. And by the way, like, criminals are incredibly innovative. They're like some of the best beta testers in crypto and artificial intelligence and other. They actually are very, very can be very adaptive and resilient, and can use new technology faster than any government can ever keep up with them. But I think most companies, especially in the emerging technology space, emerging payments, et cetera, you almost, if you're not using, or at least considering the use of artificial intelligence models in detecting patterns, some of these models can detect things that humans can't, no matter how good your transaction processing system is. So I think in identifying those patterns, does it also sometimes raise false positive? Yes. And I think you have to build in, other processes to be able to detect, to be able to address those. But I don't know if that answers the question or answers a completely different question. If not, I'm happy to stick around afterwards and help. But Maria Claudia, please let me know where I got that wrong.
I loved your answer. But I agree. I mean, I think AI is really important to actually understand the data that is being processed by fintechs and to actually detect and mitigate any money laundering or any risk in general. But you do have to understand how that AI that you're using was actually how it was built, where it comes from, how it was how it learned, right? Because those principles are the ones that are going to at the end, when you implement that AI, to get the less false positive possible, right? Or as Gregory mentioned, to not to have actually the bad guys decide or give green light on which transactions you should accept or not. So it's important to understand what you're using and how it was built, the principles under which it was built.
Okay, thank you. We have one more question that was put in the chat recently. Do you have time to answer the last minute? Okay. So, how should a compliance officer manage regulatory gray areas in unregulated business lines to prevent risk from materializing and causing adverse effects on the company? And under what circumstances should they formally recommend discontinuing a business activity? I know it's a little bit long, but I think it's worth it.
No, that's a great question. But I think Maria Claudia is going to start off on this one, right?
Sure. We have to understand that compliance officers are not there to recommend discontinuing business activity, but actually understanding the risks the company faces, how they can be mitigated, and actually understand the risk. How do you say that in English? Like the acceptance of the risk from the company. They have to have a definition on what they are likely to accept. And at the end, it's actually the business. You, like the compliance officer, like from my perspective, what should do is actually raise their hand, say, okay, if you continue with this business model in this gray area, these are the risks. Okay, I'm identifying the risks. This is something you could face if the risk actually comes true or happens. If the business understands what they're facing, they will decide whether they accept or they don't accept that risk, right? So compliance officers, I think that, and mostly in gray areas where regulation is actually not that clear, where regulation is not that clear, that it happens a lot, to just raise their hand, say, okay, this is the risk exposure. Are you willing to accept it or not? And at the end, let the business decide whether they should continue or not continue.
I agree with that mostly, almost entirely. And maybe it's just because I think there. First off, I fully agree with. Look, the role of the compliance officer is to flag the risk, and it's also, I think there's a corollary to that or a companion to that, which is to say also, look, if there's a way that you can say, hey, look, if we do it just a different way, we could get to the same place. I think that's why it's really important to get really embedded with the business teams and really to know what your tech teams and your business teams, what they're trying to do. Like, what's the goal you're trying to accomplish? And maybe instead of going this way, if we change it around just with these two features, we can actually get to a better place while also mitigating the risk. So I really do think that that's the job of a successful compliance officer, is to understand the goals of the business and also help them get to where they want to go in the most compliant way. I think there are some circumstances where, gray areas become really gray areas. And there does come a point where um, I've seen compliance officers and legal officers within a company have to say, if you do this, if you cross this line, I can't be a part of it. Now, that's where it's like, that's really dark gray. That's where it's like close to black, or where it's very clearly. Unfortunately, I've seen that happen where someone, a friend of mine here, just had to say, like, look, I can't be a part of this because the company is clearly taking this isn't a close call, and this isn't defensible on any other things. That's not a gray area. That's a charcoal gray, very dark blackish gray area where the company is winding up in legal, potentially winding up in legal jeopardy, and potentially that person, that compliance officer, can also be charged. And I've charged compliance officers before as a regulator, where they've kind of just basically, let things happen even though they knew it was illegal. So that's the only nuance I would put on that answer. Really good question, though, Arnando.
Thanks for your responses again. They are really valuable.
Thank you, everyone who sent questions. Thank you, Gregory and Maria Clara. I cannot stress this enough. This is such a privileged space. I know it's pretty late, and I think to have 45 people at 9 p.m. is pretty amazing. You guys are rock stars. And so before we wrap up, maybe one quick thing that you would like this audience to walk away with, and maybe like a question to further grow our knowledge on the subject, just something that you wish to say to us, basically.
I really just want to congratulate everyone that is here, because it's, as you mentioned, Sophie, being here at 9 p.m., hearing us talking about compliance, which is something that, like a few years ago, we wouldn't have this audience. So it's great to have everyone here, and yes, to that everyone that is interested in fintech or this technology new era that we're facing right now. Just, it's great to see you here and see that you really want to be compliant or understand how to have a successful business being compliant.
Sure. No, I echo that. I think that's really that's a really good point. And I really appreciate everyone being here. By the way, it's on the East Coast of the U.S. It's 10:15, Sophie. So thanks for acknowledging that also. No, look, I think you're really at an exciting time in the law and in the state of compliance, and especially in this area with crypto and fintech generally. It's really where some of the rules are being reconsidered because they don't fit. They don't fit as neatly as they should. And I think between, emerging technology and new global challenges, international frictions. I'm sorry, I come from the US. We cause most of the international frictions. But I think all of those, lead to really, really challenging, but also highly interesting times. I love I loved being in government. I loved playing cops and robbers as a prosecutor and being a regulator. I loved working for a tech company, and I love working for a law firm. I mean, I'm really, really lucky. I go into work and I get to say, like, I can't believe they pay me to do this all day. And it's largely because I get to work with people like Maria Claudia and Sophie and work with students and new attorneys, like new practitioners and compliance officers like you guys. So Look, I just want to say thank you for letting me be just a small part of this. And I think I wind up learning, I think I wound up learning more from Maria Claudia's points than anything I said. So if you're going to listen to one of us, listen to her, not me. But again, just want to say thank you for taking the evening with us.
Thank you, Gregory, for those kind words, and thank you, Maria Claudia, and to you both. Your generosity really has been remarkable. You gave us your time and a lot of candor, with which you approached every question. To our audience, thank you for your attention. Thank you for your questions. We hope that what you heard tonight is useful, and not just as information, but particularly as perspective. Because Maria Claudia and Gregory come from such different vantage points, but were agreed on so many points. So a recording of this session will be circulated through our usual channels, if you guys are okay with that. And we hope to write a takeaway article from all of this. Again, on behalf of the Semillero and the university, thank you very much. And if you have 30 seconds, we would like to take a picture with everybody, like a screenshot of the Zoom call, I guess. Not really a picture, but it's close enough. So if anybody in the audience wants to turn on their camera and be in the frame with our guests, now is their time.
They're shy. No, Fabio is there. That's a mute.
I'm sorry. I was saying that even if you're at the gym or in bed, you can turn your camera on. It's just for a cute little memory. Okay. Santi, can you take the screenshot? We'll give it 30 seconds. Thank you guys for being so engaged at this hour. I think for Maria Claudia and Gregory, it's also nice to see that they were speaking to actual students, and they were very engaged with our conversation. This is the virtual equivalent of a standing ovation, basically. Okay, let's do it.